It's really been one of those weeks. One of those weeks where you thank God it's Friday and hang up the towel. Stocks had a rough week, bonds had a rough week, crypto had a rough week, and for all of the earnings madness, fraud, economic data, and everything in between, things might only get crazier next week because we have a US election, and when you think it couldn't get any more wild, we end the week with the FOMC Fed rate decision, and it feels as if November's decision has been put on the back burner. But on this channel, we're bringing you all the facts and everything you need to know about next week. So as probably the craziest week in the year approaches, we need to talk about what has been and where we're going. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks staged a comeback on Friday as investors digested a big miss in the monthly jobs report and welcomed Amazon and Intel's earnings. Amazon gained 6% on the day, Intel gained nearly 8% on the day, and this lit a fire under semiconductors, software, as well as infrastructure. However, Apple, Google, and Meta did not participate. However, Google and Meta were flat on the day, so they didn't contribute to the overall market losses. We also saw very mixed price action in the broader market. Financials were half and half, same too here with healthcare, but the real losers being real estate, energy, and utilities on the day. And despite the turnaround, the S&P 500 actually fell 1.38% this week, a very brutal week led by selling in the technology sector, utilities, as well as real estate. And the best performing sectors this week was the XLC communication services as well as the financials. But a brutal week, almost every sector lost. But if you were in the right stocks ahead of earnings, you did very well this week. If you were in stuff like Amazon, Intel, Paycom, Google, you did very, very well. My portfolio up 2.8% this week. I had a great week, complete outperformance, and I do think my portfolio will continue to outperform into the end of the year. Now, Amazon's earnings guides, they posted a beat on the top line, bottom line. They also had very positive guidance outlook, as well as some remarks from Andy Jassy, the CEO, on the company's AI business. He had some very bullish stuff to say there. Margins inflected in a big way in the AWS segment, and the market really liked that. I think we see Amazon probably closer to 220 before the end of the year. We just have to get past this volatility. Intel shares were up 8% today, guys, after reporting third quarter earnings after the bell. Now, they beat expectations on revenue, missed on earnings. However, they guided for a positive fourth quarter. They also beat on data center revenue, which helped send the stock higher. And overall, this was a very mixed earnings report, except on guidance. Guidance was very strong, and that's why the stock's rallying. However, I am not getting into Intel. I don't want my money anywhere near this name. Looking at sectors overall on the day, what we did here on Friday, the S&P 500 did gain a very strong day when you look at it in isolation. The XLY, the best performing sector, pretty much Amazon, up 1.63%, followed by technology and then healthcare. And today's gains were weighed down by utilities, real estate, energy, and materials. So really anything tied to commodities. And we saw mixed price action in the broader market. Large cap growth, the outperformer, and growth in general is really where you wanted to be today. And value stocks took it on the chin, but a very mixed day. But when you have the large caps gain, large growth gain, you're going to see the overall market move higher, particularly in the S&P 500, the NASDAQ 100, as well as the Dow. And for some of the mixed price action we got in the market today, we also got, I would say, very positive data. Now, look at the non-farms. Yes, we did miss by a wide margin, but those numbers were weighed by the hurricanes as well as strike activity, most prominently at Boeing. But if we actually look at the unemployment rate, it stayed the same. The household survey was actually very, very good, maybe slightly weaker than expected, but the household survey was very, very good. We also got ADP numbers. They were strong. The JOLTS numbers was strong. Initial jobless claims was very strong. So this number right here being weighed down by external factors, and so probably a noisy print this month, and that's why the market kind of just shrugged off this disappointing headline and took it in stride. We also saw gains in hourly wages month over month, but the year-over-year figures came in line, and US final manufacturing PMIs actually beat expectation. and so too did construction spending. So I would say this was very, very strong economic data, and the market is actually still pricing in a 25 basis point rate cut in next week's Fed decision. We have to see how they're going to interpret this data in next week's FOMC, but we'll take it one day at a time. We have the election to get through first. We also have a huge week of earnings, and we have the FOMC. So a pivotal week next week. Nonetheless, we are still looking right now for a 25 basis point rate cut. At least that's what the betting markets are telling us. And then looking at market breadth overall, guys, we did see deterioration in the 5-day, 20-day, and 50-day moving averages. However, the longer term and medium term averages look very, very solid. We did see a slight uptick from yesterday into today. However, the 50-day is what really concerns me, because last week 51% of stocks were above their 50-day. Now it's 48%, and this is not too good when you look at it in aggregate. Nonetheless, longer term averages remain very, very strong, and that's exactly what you want to see. And guys, let's dive into the chart. The S&P 500 gained 0.41%, the Nasdaq 100 0.72%, the IWM gained half a percentage point here today, and we're seeing some fairly upbeat price action in the Qs and the SPY. In fact, the Qs up a full 1% today if you take the extended hours price action into consideration as well. And all of that price action was on the back of yields actually gaining. The 2-year, 10-year, and 30-year yield all gained. The dollar gained as well. And we are seeing a very weird market dynamic where yields are up and stocks are up too. And when yields fall, stocks fall. That's the price action we've been seeing in the last couple of weeks. Nonetheless, falling yields should be a tailwind for equities into the end of the year. We're just in a heightened volatile market that should dissipate once we get this FOMC decision behind us, as well as the election. On the back of a stronger dollar, commodities did fall. Gold fell 0.28%, silver 0.66%, crude did gain, Bitcoin lost as well. All in all, guys, we saw very positive momentum in equities, but a lackluster week nonetheless. If we actually hop onto the weekly chart, let's go to the US 500. We can see that, well, we are still putting in higher highs, higher lows, and we very, very recently made an all-time high. We are in a weekly downtrend, which has extended to a daily downtrend, and that means we are looking for lower levels to buy the dip. So what levels are we looking to exactly? Now, in the very near term, the first level would be the 56.42 level. It's about 80 points from where we are right now. The reason why it's important is because we used it as resistance right here again, and it's actually where we did a little bit of a spring to the upside. So the first level on a technical basis is the 56.42 level. Find support right here, move higher, Bob's your uncle, new all-time highs from there. However, if we go ahead and we actually break this level to the downside, the level we would then next look to is actually a zone. I would say this zone right here, anywhere from the 52.50 all the way to the 53.80 level, where we saw resistance coming to the market right here. We bounced off it and moved higher. We found support at this level right here, as well as this level right here. So I think anywhere inside this area, if we do break the 56.42, that's where we should find support and then move higher from there. I don't think the markets are going to go any lower than the 5200 area, and that's why I'm confident to say if we don't find support next week at the 56.42, we'll find support inside this zone and move higher from there. So guys, dollar cost average at this level right here, 56.42, and then this zone right here. Mark these levels on your charts. Those are the key levels on the weekly chart. And if we go onto the daily chart, things look a lot more nuanced. Now, the 56.42 area is right around the corner. We could see that price action on Monday if we actually pull back and find support right there. However, if we don't hold this level, it's going to be a pretty vicious sell side next week to get to the 53.86 level. And if we actually take a measured move from the 56.42 level all the way to the lower end of the zone, we're looking at 6% downside, and to the upper end, we're looking at 4%. That could happen in a week, particularly with the election, FOMC, earnings, and all of the data we're getting next week. But more likely, if we are to see a pullback to this zone right here, it's going to take a couple of weeks. I mean, this week was a pretty vicious week, and we were only down 1.2%. So to get to this level will take us a couple of weeks, but I am a strong buyer inside the zone if we do get there. Looking at the SPX, let's go to the gamma levels. We did see a couple of changes, guys. We actually, if we just zoom in, we did see the put support move lower. The put support yesterday was right on here. It did move lower, which does suggest that we do go to the 5650 area, which does align with the 5642 level on our technical chart. So there's a bit of confluence here with the put support as well as the level on the technical chart, and that could be a good support if we do move higher. You do have to understand we are in negative gamma, and we did find resistance at the gamma flip. We saw huge selling, but we couldn't get into positive gamma in the S&P 500, and then bears took us lower. If we actually dive into the daily chart, we saw very, very volatile price action here today. So not the daily chart, sorry, the one-day chart. You can see we sort of gapped up here on the open, rallied. We were up at one point here, 1.3% for the day we gained, and then we saw lower lows, lower highs into the close. The S&P 500 paired most of their losses, but still up for the day, 0.41%. So very, very vicious price action, and that's what happens in negative gamma. Negative gamma, you buy into strength, sell into weakness, and that's why you get this very volatile price action. Whereas in positive gamma, you buy dips, sell rips, and generally you see that type of price action. That's why we always want to be in positive gamma, because negative gamma is very, very volatile, and that's also why you want to buy dips in negative gamma very, very quickly. Nonetheless, guys, our target into next week is the 5650 area. If you're a brave man and you dollar cost average, you could actually start buying right here. We did see bulls and bears react appropriately at this level, at the 5728 level. However, all things considered, based on market technicals, we should probably see the 5650 level. We are in a daily downtrend, and the only time I would say we're out of that downtrend is if we go back into positive gamma. Then we would look to the core resistance. So right now, in this negative gamma environment, guys, our target is the 5650 area. We have to change with market dynamics, and you see I'm bullish in positive gamma and bearish in negative gamma, but still I lean bullish by saying we want to buy dips. We never really take shorts in this market. Looking at the NASDAQ 100, the levels have not changed, but we are in negative gamma, and our target is the 19,800 level. And the RTY, guys, this thing is holding up really, really well. The RTY is set to bounce in a very big way, I think, into the end of the year or early 2025. I mean, guys, look at yields. Yields and the dollar were up significantly, right? If you look at yields and the dollar, right, this would normally weigh on small caps, and the Russell 2000 gained 0.56% today. Yes, it was very volatile. Look at this wick, right? So bears definitely did come in from the highs, but to see this type of price action and to still hold this 5200 level as support, that's very, very strong. And I think as long as we stay above this level right here, I think this just means we do go higher for the Russell 2000. The big problem is that we actually didn't break this high. We traded at these highs, and so this probably does look to like a double top to some technicians in a way. Some people will say this is like a head and shoulders. I don't really like these chart patterns, but there is that headwind for the Russell 2000. Nonetheless, I remain bullish. I like the higher low. We're sort of putting in here, kinda, as long as we hold it, and then we should actually spring and go from there. But if we do break this level, guys, it's the 2100 level, 2090 level, straight up for the Russell 2000. So bulls, do your thing. Hold this level, move higher. Otherwise, we are definitely going lower, and the target then would just be like the 2100 to 2090, 2080 level in the Russell 2000. Looking at the RSP, we're at the 176 area. This is one of the buy levels. So look, if you miss this rally, you would buy here in the RSP. The next zone would actually be the 170 to 171, 172 level right here. Sort of this area, sort of this zone right here. That's where you want to buy. Nonetheless, I think this is great because we're going to see a 200 RSP in 2025. So, buy here, dollar cost average, sit through the volatility, keep some spare cash, because if we do break this key support zone and get to the 170, 172 area, this is a great zone to buy for further upside. I don't think we're going to go much lower than this. If we do, that is a bit of an issue considering where the S&P 500 is trading right now. But I think 170 to 172, great area to buy. But I'm not opposed to actually buying right here, especially if you have a very solid dollar cost average strategy. All in all, guys, things are looking largely constructive for equities. Look at TLT, looking at bonds. Let's look at bonds year to date, something we haven't looked at in a while. They've been very volatile. We saw some massive selling into the start of the year, huge buying. Now we're seeing selling again. again. I do think this is a great place to get bonds, especially with the FOMC looming next week, but economic data is still very strong. Yields are pushing higher, and that is having an overall tangible effect on the bond market, specifically TLT. Gold, I think you definitely need an allocation of gold in your portfolio. Year to date, what is the percentage return of gold? 32%. Absolutely crazy. It's holding in there much better than equities, much better than most asset classes. And I think we're going to see 3,000 gold into 2025. And then silver, I'm actually super bullish on silver. I think we're going to see before the end of the year, maybe $36, $37, $38 silver. But looking at equities, because that's what we mostly focus on this channel, guys. The S&P 500, we want to buy dips at the 5650 area. For the NASDAQ, it's the 19,800 area. And the RTY, it's where we are right now, the 2195 area. You want to be buyers of those dips. And if you want individual names, stocks I like right now. Google, I really do like Google. Great earnings. I think it's going to get to all-time highs in the first or second quarter 2025. It's just participating in the market volatility, but great earnings. I also really like Amazon. I really like their earnings. I think we should see it trade at 220 before the end of the year. I still like PayPal. You know, their earnings actually came in line. And if you go listen to the conference call, the CFO really dispelled a lot of the rumors. And that's why we actually are seeing PayPal sort of hold the $77, $80 area. So I do think if you did miss out on the rally on PayPal, I think this is a great place to buy. And I think a great place to buy all the way down to the $74 area is a really, really good zone to buy for PayPal. Paycom, I like the stock. I own the stock, a huge gap up. It's probably fully valued right now. Paycom was up 0.78% today after being up 21% yesterday. I still like Paycom. It's probably fully valued for this earnings season. I've seen some valuations out there at 220, but the majority of the gains have been made. Nonetheless, longer term, the stock should fly back to its all-time highs in the next 3 or so years. And for those of you that are in Australia, a stock I've also been buying lately is PXA Pexa Group. I like this name, and the lower it goes, I will continue to buy. I think this is a great level of support to buy here. A very, very solid name, a monopoly, probably bigger monopoly than ASML if you look at it on a relative basis. And this is the zone, this is the area where you want to buy on a technical basis. I like the stock, I like the fundamentals. Very, very solid business, great business. So those are individual names apart from stuff like the RSP, NASDAQ 100, S&P 500 I would really get to. On the ETF front, guys, we want to look at stuff like the CAF index, small cap cash cows, as well as SHXQ, at least 4 to get exposure to small caps. That's the small cap quality ETF. And guys, let's talk about sentiment. This is CNN's Fear and Greed Index. And right now, fear is driving the US market. Just 3 days ago, we were firmly in greed territory. We have now pushed right into the fear zone ever so slightly, probably teetering between neutral and fear. But fear is driving the market right now, and that causes people to do irrational things. And that's why we need to bring it back to earnings. And at the end of the day, guys, the further we pull back in equities, I do want to be buyers of any dips simply because things are looking really, really good. This is yesterday's earnings. This is today's, right? So because they change dynamically in earnings season, we can actually see right here. Look at earnings so far for the S&P 500 yesterday, plus 6%. Look at it today. 7%. And that was after Uber, Amazon, and Apple's earnings. We also saw, excluding energy, a huge move up. Earnings ex energy is plus 10.1%. And guys, I think the big thing out of all of this is that margins actually improved ever so slightly. 12.1% is the current margin profile. Yesterday, we were at 12.0%, and 324 companies have reported in the S&P 500. So earnings looking very, very solid, especially when you look at estimates at the start of earnings season. We were penciling in 4.7% earnings growth, now at 7%. And revenue growth actually beating by a wide margin as well. Very, very solid. And for those of you that aren't in like energy stocks or material stocks, I know some of you own industrial stocks, you're doing really well this earnings season. You're seeing your earnings grow significantly, especially if you own Google, Meta, Amazon. And I know the initial reactions aren't indicative of those earnings. Earnings season so far has been very, very good. But let's switch gears and talk a bit about the election. And this was a poll that Bloomberg did, and they asked, The S&P 500 has gained about 2% a month so far this year. Under each candidate, will those gains accelerate, stay the same, slow, or turn into losses? 60% of individuals said under Trump, those gains will either accelerate or stay the same, whereas in the Kamala campaign, they said 30% of individuals said the gains will stay the same, but an equal amount said those gains will actually slow. It was about 20% for both said they might turn into losses. All in all, it does look like the market thinks gains will accelerate under Trump and roughly stay the same under Harris. Very interesting data right there. But let's switch gears and talk about the regulatory environment, guys. This is private equity firms' takeover of public US companies. And guys, private equity firms are back in the books. Deals valued at over $1 billion or more are on the rise. This is PE firms taking over US public companies. We saw $85 billion in deals this year so far involving listed US targets. This is up significantly at roughly the same point in 2023 and the second highest year-to-date tally since 2010. So as rates have come down in the last year, because they are down on a year-over-year basis, yields this time last year was about 5%. The 10-year, we're now sitting at about 4.3%. So we are starting to see life again in M&A activity. And that's because companies are simply making money despite all of the macro we've had in the last year. And this is showcased none better than buybacks, which essentially just tells us corporate enthusiasm and optimism. Buybacks are nearing 2019 highs. This was the pre-COVID highs when things were looking very, very good. And this just goes to show optimism, guys, for the next year and also maybe market value. And you like to see that. And also, companies will be adding up to $6 billion per day in buybacks every day into the end of the year, which is 33 trading days left of the year. They still have to execute 21% of total yearly buybacks. And once this blackout period is over, sometime mid next week, we should see overall buybacks become a net positive for the equity market. And the lower we do go, it just means overall cheaper buybacks. And you do want to buy the dip, because when we have stuff like Apple, Meta, Google, Microsoft get out of their buyback blackout period, you are going to see positive momentum in the market. However, there is still a lot of fear right now, and I think we need to see that fear subside after the election, and then we can actually get more positive market momentum. But these are simply tailwinds for the market, buybacks as well as M&A sentiment, while in fear. Overall, if you look at it in aggregate, looking very strong. And all in all, guys, you do want to be buyers of dips on this weakness that we are seeing in the market. But it also depends on the stocks you're in. Right now, my portfolio this week has actually gained 2.1% when the broader market is down close to that amount so far this week. So it really depends. If you're in stuff like Google, Paycom, and Visa, you're doing very, very well. But if you are in the major indices like the Qs and SPY, then the portfolio not looking that great this week. Diving into the macro, looking at the economy, guys, and we officially have the fourth quarter print for the Fed's GDP now. The estimate is sitting at about 2.7%. So the fourth quarter growth looking largely robust. And despite everything we've seen in the market, guys, the economic surprise continues to move higher. A rising US economic surprise index is indicative of improving economic conditions that can enhance investor sentiment and stimulate growth in the equity markets, particularly 6 and 12 months down the road. Now, guys, we also got personal income and spending data yesterday, and pretty much to sum everything up, personal income and spending is strong, inflation softer than expected, income growth is still running well ahead of inflation. The last 3 months annualized headline PCE is up 1.8%, disposable income up 2.9%, and employee compensation up 5.6%. But in yesterday's data, we actually saw disposable income fall move lower, and that's because personal income receipts on assets, stuff like interest payments and dividends, weren't quite as strong for this month. And that's why we did see a little bit of a deacceleration in personal income from assets. Nonetheless, if you look at disposable income, employee compensation, things looking very, very robust on a 3-month annualized, 6-month annualized, and a 1-year annualized basis. And all of these figures right here is outpacing the rate of inflation. That's exactly what you want to see. And guys, diving into earnings next week, we still have some very notable names, although not as big as this past week. Still a very huge week in earnings because we have Berkshire reporting, Qualcomm, ARM Holdings, Vertex, Arista Networks, Melly, Palantir, Airbnb, all reporting next week. We also have a couple of other notable names: CVS, Fortinet, NXPI, The Trade Desk, AppLovin Corporation. Guys, they're all reporting next week. We also have like Diamondback, Monster Energy, Fair Isaac Corp, Coupang. They're all reporting next week. So definitely not as big a week as we just had, but definitely stocks that can move certain sectors, specifically in financials, semiconductors, as well as many software names. But the spotlight next week is going to be on all of the data we get. The big one is actually going to be here on Tuesday, the presidential election. So that's really going to drive a lot of the market sentiment as well as the news cycle. But on Tuesday too, we also have the PMIs, S&P PMIs. We have the S&P Global Composite and Services PMIs, the ISM PMIs. We also have a huge 10-year note auction and factory orders on Monday, but all eyes on the presidential election on Tuesday. And Wednesday, we have a 30-year bond auction. And then Thursday, we actually have the Fed's interest rate decision, as well as initial jobless claims, and then consumer sentiment on Friday. So the big two high impact events are the interest rate decision, the FOMC, as well as the presidential election on Thursday and Tuesday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.